Hello everyone. We've just released our monthly India market outlook titled Can the Uptrend Sustain? In this episode, we discuss a key investor question. After the strong rebound over the past month, can the uptrend sustain in Indian equities? To set a context, the US Liberation Day tariff announcements proved to be harsher than market expectations. While partial rollback has helped improve market sentiments, volatility remains high, with the Nifty index achieving a peak to trough drawdown of approximately 16%, the second 10% drawdown this year. However, the Nifty index has recovered about 11% since the early April 2025 low, raising questions on the sustenance of this uptrend. While valuations have arguably moved higher post the recent recovery, we believe the risk reward remains favorable given the following factors. First, improving macro fundamentals. Since February 2025, most high frequency indicators, which includes the PMIs, industrial production, GST collections, etc., point to a gradual improvement in domestic demand. The RBI continues to ease financial conditions through policy rate cuts and aggressive liquidity boosting measures, driving bond yields lower. This, along with the tax cut led consumption boost announced in the annual budget, should help support a cyclical growth and corporate earnings recovery. Second factor is better risk reward. Domestic bond yields have declined to the lowest since 2021 amid RBI's policy easing and positive demand and supply balance. This, along with fairer equities valuation, has driven the yield gap to 1.4%, a level which has been considered favorable for equities' future performance. The third factor, finally, is the lower risk of tariff shocks. Trump's policy narrative has changed from trade tariffs to trade deals in the recent weeks. After pausing the reciprocal tariffs, the US appears keen to seal an interim trade deal with key partners over the next 100 days. Media reports suggest India could be among the earliest markets to get a US trade deal. Now, considering these factors in mind, we've made certain changes to manage risk. We've downgraded information technology to underweight given the sector's lackluster fourth quarter fiscal 2025 earnings performance, weak fiscal year 2026 performance guidance, and a strong linkage to US growth outlook. We've also upgraded healthcare to overweight given the sector's defensive nature, better resilience to tariff uncertainties, and stable earnings growth outlook. In our opportunistic ideas for 2025, we have closed our preference for India's small caps, given week's earning delivery in the fourth quarter of fiscal 2025 and further downward revisions to fiscal 2026 earnings estimates amid stretched valuation premiums over large caps. Our broad theme for 2025 remains unchanged. At level 1, we continue to have a preference for equities funded by an underweight cash. We continue to expect bonds to outperform cash as modest inflationary pressures, RBI's policy easing, active liquidity management, and favorable bond demand supply balance is likely to drive bond yields lower. Within equities, we continue to have a preference for large caps given better margin of safety in terms of earnings and valuations compared to the broader markets. Within bonds, we are overweight medium and long maturity bonds and high quality or AAA rated corporate bonds given attractive absolute yields. Gold continues to remain neutral and a strong portfolio hedge against downside risks. At this point, I'll take a pause and thank you as always for listening. Do reach out to your relationship manager for a copy of our India Market Outlook. You can also find it on our website at www.sc.com/in the SC Invest section. Alternately, you can also find it in the Standard Chartered Market Views on the Go India page. Thanks very much.